Welcome to the latest episode of our podcast series for financial advisors. Today's episode is An Advisor's Guide to 2025, the impact of 2024 on the new year. It's an industry update with my partner, Louis Diamond. I'm Mindy Diamond, and this is the Diamond Podcast for financial advisors. At Diamond Consultants, our mission is to help advisors live their best business life. We want every elite advisor to find exactly the right place for their business and their clients to thrive, whether it's at a wirehouse, a regional, boutique, or independent firm. As the industry's leading recruiters and consultants, we've transitioned more than $250 billion in assets under management in the past decade, and each year, 25% of transitioning advisors who manage $1 billion or more are our clients. If you'd like to talk, please feel free to give us a call at 908-879-1002. Are you a financial advisor who's curious about whether you're in the best place to serve clients or if there might be a better way to optimize your business for the future? Should I Stay or Should I Go is a new book that serves as a self-guided journey, walking you through the key steps that Diamond Consultants takes with our advisor clients, whether considering change or not. Visit diamond-consultants.com/thebook to learn more. It's hard to imagine that we've wrapped up yet another year, and an exciting one it was. The election activity aside, the wealth management industry made headlines on its own, with mega teams on the move, massive M&A deals, and stunning leadership shifts. So what does this mean for advisors? How does all of this activity color the year ahead? Louis and I take our annual look back at the year past and share some thoughts on the year ahead, all with the goal of informing listeners so they can be better prepared and make decisions with the power of knowledge behind them. There's a lot to discuss, so let's get to it. Louis, I'm thrilled you're here with me.
Me too. This is always one of the most exciting and engaging episodes of the year. So crazy that we're already recording it, but it's been a really exciting year. So lots to talk about.
Yeah. All right. So let's talk about the 2024 big stories and trends that will color 2025. So let's take the first one. Movement was seemingly down. We will publish our annual 2024 transition report in the first quarter of 25, and we will validate that. But let's talk about it. Was movement down as much as it seems? What part of movement was down? What was really going on there?
Yeah, so I'd say anecdotally, it feels like there were less advisors on the move than in 2023 and 22, and certainly during the COVID years. And speaking to a lot of our clients, most reported that recruiting flows were a little bit off where they expected. But that doesn't mean that everyone's staying put or there isn't a ton of opportunity for advisors who are looking to make a change. I think what we've actually seen is larger teams than ever before are in play. So even if there's less discrete transitions than in prior years, we saw some monumental transitions. The M&A market's been extremely hot. And to me, it's just a normal business cycle. The markets were up big time this year. So a lot of times folks get comfortable or don't want to upset momentum. It was a presidential election year, which sometimes creates some uncertainty. There weren't really any major policy changes or firms pulling out of types of business. There wasn't a First Republic type event. So I think it was business as usual. We'll get into some of like the major themes and stories and how that's going to impact 2025. But I think seeing some early things like UBS changing compensation in a meaningful way at the end of 2024 and just some of the other trends that we're going to talk about, I think 2025 has potential to be one of the more active years of advisor movement we've seen in some time.
So let me ask you a question about that. And I actually think the same thing about 2025. But one of the things that I think kept a lot of advisors that might have been unhappy and might otherwise considered a move kept them in their seat was these retire in place programs, especially at the major firms. But those programs are still around. And seemingly a lot of the firms have made some positive changes, positive for the advisors who will take the programs. So why do you think 2025 will be a better year?
Yep. Those sunset programs are absolutely still at play. Without those sunset programs, we probably see an extra 2% of total advisors changing firms in a given year, would be my prediction. And it keeps a ton of very large producers who have been at their firms forever. It keeps younger advisors who get tied into these programs in their seats. So that's still going to be in play, not just for 2025, but probably in perpetuity. And Merrill made their program better for certain advisors. UBS has changed it. Most of the firms, when they change these programs, they tend to get better for the retiring advisor and a little bit more punitive or restrictive for the inheriting team. So I don't think that's going to necessarily change movement activity. But I think, and we'll get into it with this episode, I think now we have some pent up demand from folks who were worried about moving near the election. Hopefully the market keeps going up, but if there's a market correction or things normalize a little bit, I think momentum begins to slow and maybe it's easier for folks to reconcile change. I can't overstate enough how big I think the UBS comp plan change was. So I think we'll see a lot of UBS advisors in play in the first and second quarter of 2025. And then I don't want to steal the rest of the show because we'll talk about how some other big things we saw in 2024 have the potential to impact movement in 25.
Yeah, I like what you said about pent up demand because I agree with that. I think that the promise or the positive impact, positive changes, let's say, on firms' retire in place programs are enough to keep advisors in their seats for only so long. And then take the example of the UBS comp plan change. That's enough to make an advisor who might otherwise say, you know what, it's more than good enough. I'm going to stay put, especially because I have the opportunity to retire out and monetize my business at day's end. That's enough. That comp plan change is enough to make that person who might otherwise stay say, you know what, that was the straw that broke the camel's back. So we just did an episode. I want to remind our listeners, for anybody who missed it, Louis actually just recorded. It was a fabulous episode a couple of weeks ago, talking all about the UBS comp plan change. And we don't need to go into detail here, but we'll link the episode in the show notes and make sure if you're interested, you listen to that show. All right. So Louis, what else?
So I think the next key story or trend from 2024 that will no doubt spill into 2000 is the dynamic of lowering interest rates from the Fed and what it means for firms' net interest margin revenue. And that combined with some major class action lawsuits and seemingly regulatory pressure on firms of all shapes and sizes to begin paying more in cash sweep revenue to clients. This is a under the radar to me type change. Every advisor is familiar with interest rates and how clients are paid on cash, but I think the impact on firm profitability when interest rates and cash sweep revenue are high is probably pretty staggering for folks if they really understood it. So most of these firms, especially independent firms, they make a ton of their profit margin from the spread between what they pay clients out on in cash and what they can lend it at. And the impact of this, aside from hurting their financial statements, is the potential, I think, we've seen it a little bit, of deals either not being able to increase or rise as they have. Some firms we've seen tweak deals to make them a little bit lower. There's rumors, and we've seen some firms increase platform fees or charge administrative fees. But I think as all this kind of develops, there is potential for changes in compensation or compensation practices at most every firm, because firms either have to take the loss and report it to shareholders or figure out other ways to recoup the revenue. So the UBS comp plan change that we talked about, I don't believe it was driven by these dynamics, but that could be an example of some of the changes that firms enact as they're trying to find equilibrium in this new environment.
Yeah. I think the next thing we should be talking about is the fact that this is the first year So in 7 years, since 2017, that all four wirehouses are aggressively recruiting. There actually is the potential for real impact on that because there's a couple of things we know to be true. The most important of which is that competition drives deals and drives motivation. When the independent space sort of first became a really valid option for a top team, it forced the big firms to up their deals because they were losing a lot of advisors they otherwise normally might have won. Typically, when for the last 7 years, we've seen at least one, in some cases, two of the wirehouses pull back either on deals, either the deals they were offering or not necessarily recruiting at all. The most recent firm to pull out of recruiting was Merrill. But in this past year, Merrill came back with a vengeance and is actually paying one of the biggest deals on the street. And that, we believe, will force all four firms to keep their deals high. Competition is a great thing for advisors, and it provides more choice. It's ultimately a good thing for the advisors, it's a great thing for clients, and it's a good thing for the industry overall.
I completely agree. It's always like keeping up with the Joneses, even though you and I know, and most advisors know, that the four wirehouses compete with far more than just each other. They compete with the regionals, with the independent space, with firms like Rockefeller, et cetera. They tend to mirror each other's movements, the big four firms, because most of their recruiting flows are going to come from their competitors. And they typically only view their other large competitors in the same light. So seeing Merrill come back in and having a really aggressive deal only helps to raise deals or keep deals at a minimum where they are, because all the big firms fear one another in different capacities.
Yeah.
So the next trend I wanted to hit on was the fact that fintech firm Robinhood, which is very well known, announced they're acquiring Trade PMR, which to date has been the RIA custodian option within Wells Fargo or First Clearing. So Robinhood isn't a brand name, at least not yet, that's synonymous with the ultra wealthy. Most people have heard of it for varying reasons, but the fact that they're acquiring Trade PMR, which is I'd say a more boutique custodian, not as well known, and is going to turn it into their custodial offering, I think is a pretty big deal. It comes on the heels of disruptive custodians like Altruist. Envestnet, which is a major TAMP and publicly traded firm, is getting into custody. Goldman came into the space. So it seems like there's a lot of fintech firms and otherwise that are seeing the migration of assets to the RIA space and are trying to take their bite out of it and try to dethrone or take market share from the incumbent custodians like Schwab, Fidelity, and Pershing. So even if a firm like Robinhood isn't of interest to an advisor for whatever reason, the fact that we're seeing firms like this really invest and double down into the RIA channel, I think is just validation that the RIA space is here to stay and that there's a lot of promise and money and appetite for a number of firms to try to get involved.
Yeah. So I'm going to take the next one because I think it's really profound. The next trend I think we should be talking about is private equity making an even bigger splash, making its presence known even more. Some examples: we saw CD&R taking Focus Financial private. We saw Bain and Abu Dhabi Sovereign Wealth investing in Corient, which was formerly CI. Carlyle was investing in Cap Trust in 2023. TPG invested in Creative Planning and Hamrick Berg. A new private equity firm, Constellation Wealth Capital, made waves investing in some of the most sought after properties in the RIA space, like Crescent and Lido. And I think first of all, it's exciting. Going back to what we said about all four wirehouses aggressively recruiting, competition drives deals. Competition is good for advisors. So private equity entering the space does two things. It absolutely drives competition, and it absolutely drives up valuations for advisors' businesses. It will force the big firms to stay in the recruiting game, to pay really big deals, to not lower deals, et cetera. But I think one other thing that's really true about private equity entering the space is that for the most elite teams, for the biggest teams in the industry, I'm talking advisors that manage multi-billions under management and that are generating $20 or $30 million in revenue, Up until now, most of those teams assumed that unless they wanted to move from one major firm to another, Goldman to Morgan Stanley or Merrill Lynch to UBS or something of the sort, that there really was nothing that was good enough. The independent space or the multifamily office space, if you will, or ability to create a multifamily office was interesting and exciting, but the economics often didn't work because there was no way for them to capitalize the business on the way in. And many of them didn't have the appetite to go through the brain damage of starting something from scratch. But private equity now looking to invest directly in mega teams, whether those teams come from the wirehouse or traditional space, or whether those teams sit as currently as independents, private equity money's interest in those elite teams will drive a lot of movement. Louis, you and I were just talking the other day about 5 or 6 very significant teams that you and I have worked with for years that have always had their eye on possibly moving, but always assumed that there was just nothing or no one that could afford to take them out. And now those teams are very much in play, and private equity is what's been the game changer. Is there anything you'd add to that one?
No, I think that's exactly right, because it's not just private equity looking to invest or back a team that wants to run their own business, but it's these major RIA firms, many of which you mentioned, that are backed by private equity sponsors that now have a renewed or a new appetite to merge small, mid, large wirehouse practices into their firms. So we've done episodes on this. I think it's going to be potentially the next big thing, the next type of firm that advisors are really interested in. It hasn't really caught speed yet because the momentum isn't quite there. I haven't really found someone that's really cracked the code on the fair deal structure and just hasn't reached widespread acceptance as a viable option yet. But I think that's going to change. And you mentioned the names of some of the largest and most sophisticated private equity sponsors in the world that made new platform investments in the RIA channel just this year. So I think this, again, is just another proof point that that the smart money, the deep pockets, are seeing a lot of promise in our industry. So even if an advisor has no plans or no interest in starting an independent business, it's all good for validating valuations in the space. And for folks that are interested in independence now or in the future, it's a great check on the fact that there's going to be and continue to be a ton of demand for quality businesses. And that should keep multiples and valuations at a minimum where it is, but probably give it room to run into the future.
So it's worth, let's just take 2 minutes, if you will. You mentioned the fact that there hasn't been enormous momentum in this, meaning smart money, private equity money, investing in significant teams coming out of the traditional space. What kind of a deal would an elite team need to see? What would a big private equity firm need to put on the table? And I don't mean amount, I just mean in terms of structure. What is it that would get these big teams' attention?
The way these deals are typically structured today is there's little or no money up front, and there's a very large multiple that's paid at long-term capital gains after a year and 18 months and 24 months. So the multiples that a team can get, even in today's environment, is potentially far greater on a pre and post-tax basis than they can get from a typical recruiting deal. To me, the challenge has been twofold that no one's really figured out yet. The first one is big teams have very large deferred comp balances. They typically have the most at stake. And any advisor who's making a transition, in some cases, unless they're going independent, betting on themselves, et cetera, they require to take some risk off the table and get something pretty meaningful up front. So I think that's the first piece, getting more money in the hands of an advisor sooner and without the need for immediate portability. The second one is payout. RIAs don't make money in the same ways that brokerage firms and banks do. So they're not making money on cash sweep. They're not making money on lending, on adding managers to the platform and revenue share. So there's only so many ways to cut a dollar. So that means that in order for these firms to operate their businesses, even if it's a large firm that's at scale, pay a deal and also have a meaningful payout, ongoing payout to the advisor, something has to give. So I don't know what the right answer is, but we know advisor mindset. And if there is a firm that's really interested in cracking the code on this, it's going to have to be a combination of a fairly meaningful ongoing payout that's similar or in the realm of where a typical wirehouse team's at. So say in the 40 to 50, 55% range, has to be something meaningful up front. And then having all or most of the deal being capital gains with part cash and part stock. So
Yeah.
I think there's a lot of promise there, but just the structures that we've seen have lacked either all or some of those components, which typically means that someone's not going to go that direction.
Yeah. But I think it's fair to say one of the things we always do is make a bold prediction for the following year. And I think one of the bold predictions is that in 2025, we will see at least one or two very significant industry changing, career making, crazy big teams leaving, going independent, finding a private equity firm or private money, someone to capitalize them in a big way, someone to have cracked the code on what you're talking about. Because to a private equity firm or to an investor, recruiting or investing in a business that manages 10 billion and on its way to 20 billion in assets is incredibly meaningful and incredibly valuable.
Right on. I agree. All right. I'll take the next, which is more related to teaming. Most firms over the years have begun to push advisors to form teams, to create next gen talent, to let teams gain scale, to add specialized team members. Like it's usually good business for everyone, for the client, for firms, for advisors, for teams to happen. Most of the big firms have used kind of the carrot and stick approach, where they've used compensation plans to either motivate or demotivate teaming and have pushed folks to team as a result. But we're starting to see that approach back off to an extent. The most recent UBS compensation plan from the end of 2024 removed a very popular teaming incentive where instead of advisors getting paid in aggregate, so if I'm doing $1 million, you're doing $6 million, us getting paid as a $6 million team, they changed it so that we're only going to get paid at the grid rate of the highest producer. So that's more similar to how other firms have done it, but that's an example of where we're seeing some of the firms backpedal or backtrack on creating these mega teams. Because what's happened is mega teams certainly are harder to move, but they do move. And what's occurred is these very large teams that have their own investment professionals, they have paraplanners, they have next gen talent, some even have a COO, basically non-revenue producers running the business, is they begin to function like their own independent unit within a firm while still paying the 50-55% tax for not really using the resources that the firm provides. So some of it is financially motivated. If you take away teaming incentives, then the firm doesn't have to pay out as much in compensation. That was the case of UBS. But I think also it's the realization that these big teams were created, I think in large part by the big firms to retain talent, but it's having the reverse impact.
Yeah, I think what you're saying there is that these mega teams have created their own mini firms within a firm where they're less reliant as a team on the infrastructure of the firm. They're more self-sufficient. And the more self-sufficient a team is, the more, as you say, they can support themselves by having non-revenue producers support them, the less they rely on the firm and the more portable they may be and the more they may look to go elsewhere. Yep. I think one of the other things we hear a lot is big teams saying that, will the big firms continue to invest in us as big teams? And are the big firms going to be more interested in the pendulum swinging the other way and going back to looking to recruit and really invest in individual producers?
Yep.
And actually, I think the next point to talk about is that as advisors evaluate the big firms, technology is always a major motivator. But one of the things that they're going to be increasingly interested in is AI. And then, of course, on the crypto side, they will analyze their firm to see if these are things that their firms are investing in a meaningful way. And if not, those two things themselves could be reasons for an advisor to explore elsewhere. And the smaller, more boutique, more nimble firms may well be investing in those things in a more exciting or entrepreneurial way than the big behemoths can.
Yep. Yeah, I think that's right. Like it's not it couldn't be a recap episode in 2024 without talking about AI or crypto. But in all likelihood, we've seen some advisors even prioritize the ability to invest in cryptocurrencies or to pick and choose all these different AI technologies beyond just ChatGPT, but using AI to really find efficiencies in their planning process, to create financial plans, to analyze tax returns, to provide recommendations for client segmentation and emails and follow ups. So I think as AI gains more acceptance or adaptation in the professional life of a financial advisor, there's going to be a ton of proof that advisors can run faster and more efficiently by using these technologies. It's not to say that the major firms aren't spending a ton of money on AI. Morgan Stanley for years has had the Next Best Action or MBA program, which is a really, I think, probably one of the more compelling and common sense uses of AI, where it mines an advisor's book and client segmentation information for opportunities for engagement. So, on one hand, big firms have the scale to invest in AI, but to your point earlier, they tend to move much slower. They have to give more care to how everyone's going to use it, lowest common denominator use cases. So if advisors really want to harness the true power of AI and build their own tech stack and really begin to see the efficiencies, I think many are going to be motivated or compelled to do something different. But if we're seeing firms pop up too that are AI centric, firms like Savvy Wealth in the RA space, and there's some other venture capital kind of upstart disruptor type firms where AI is at its core. And I think this has some potential. We know AI is changing the world, but I do think it's going to change the industry, like it's going to change every industry. But I think what we've started to see and we'll see into 25 and 2026 is AI or lack of AI capabilities or the ability to recommend crypto as being an actual motivator for someone to consider change.
Yeah, I think you're right.
The last trend we have to take us home today is more related to the independent space. So large practices that practice under an independent broker dealer, Northwestern Mutual, Mass Mutual, LPL Financial, et cetera, now have more choices than ever before. It's not just choices in terms of different broker dealers to go to, but there's the dynamics of starting an RIA or joining one. But where these options really become the most relevant is around succession and around maximizing enterprise value. So a dynamic we've seen occur are as these practices get larger under their captive broker dealer, they begin to have far fewer options for a buyer. Or put another way, it becomes a high class problem where they outgrow the potential buyers within their broker dealer. And in order to get a fair market valuation or to have an active market to buy their business, even if they're happy where they are, a lot of folks are having their hands forced and needing to either transition as part of a transaction or transition before a transaction to align themselves either with a broader pool of buyers in the RIA channel or to move to broker dealers that have the capital to buy the practices directly. So this one might not be relevant to many advisors that listen, but really any advisor who's independent are being forced to make some difficult decisions because as valuations have gotten much more aggressive in the independent space, it means that someone within a broker dealer has to have that much more money where oftentimes they don't have institutional capital backing in order to strike a fair deal for an advisor who wants to maximize their value before an exit.
I think what all of this means as we wrap up here is that the notion, first of all, about pent-up demand, I think is the theme of this show, that I think we are predicting that 2025 will be a mega year in terms of advisor movement. And the bottom line is, I think that you would agree with me that what drives it is that advisors have real leverage. Advisors hold all the cards. Despite what the big firms want advisors to believe. You see, the big firms want advisors to believe that they own you, that if you are to leave, they scare you into believing that clients are not going to follow. They scare you into believing that the clients are yours because of the firm that in which you work. But the truth of the matter is that the advisor is running a business. And if you think about your business as a business, you hold the cards. As long as you've run a good business, a clean business, a growing business, you've done right by your clients, you hold the cards. So what does that mean? It certainly doesn't mean that every advisor should move, most certainly not. But it means that if you are uncertain that your firm or your broker dealer can be the best possible partner to allow you to grow the business, to serve clients without limitation, and ultimately to maximize the value of the business you've built, you shouldn't ever stay just because you assume there's nothing better. Because in this greatly expanded industry landscape, the waterfall of possibilities is more exciting than ever before, and the advisors hold all the cards.
That's incredibly well said, Mindy. Pent-up demand is absolutely the key theme, and I'm really excited to see how 2025 kicks off and develops. And I have no doubt that we're going to be way off on some of our predictions and what's ahead, because what's so interesting about our industry is the unpredictability. There's always something that comes out of left field, or a new firm that's aggressively entering the space, or just something completely off the reservation. But all of that creates opportunity and I think intrigue for advisors. So I appreciate doing this with you and batting these ideas back and forth. And we'll keep track of all these trends going into 2025.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibilities seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.